Some countries grow, some countries develop, and some never seem to move forward at all. Decades pass, governments change, policies shift, but the outcome stays the same. Slow growth, high debt, constant instability. And no matter what they try, they can't seem to break out of it. It's easy to assume this comes down to bad decisions, poor leadership, corruption. And sometimes that's part of the story. But it doesn't explain everything. Because when you look closer, you start to notice something unusual. Many of these countries aren't just struggling randomly, they're stuck in a pattern, a system that's incredibly difficult to escape. And once you're inside it, every attempt to move forward seems to pull you back in. Because the problem isn't just internal, it's structural. It's built into how global finance works, how trade is structured, and how power is distributed across the world. And that's where the story changes. Because this isn't just about individual countries failing, it's about how the system itself creates winners and keeps others from catching up. Countries borrow money to grow, to develop infrastructure, to stabilize their economies. But over time, that borrowing can turn into something else: dependence. Because once debt builds up, it has to be repaid. And repayment doesn't just take money, it takes control. Control over spending, over policy, over economic direction. Which means the more a country tries to move forward, the more it becomes tied to the system it's trying to escape. And this is where things start to loop. Borrow to grow, to repay, to slow down, borrow again, to repeat. A cycle that becomes harder to break each time. And once that cycle is in place, it doesn't just limit growth, it shapes the entire future of a country. So the real question isn't just, why do some countries struggle? It's this: what kind of system makes it so hard for them to ever escape? So how does a country actually get trapped in a system like this? It usually starts with something that seems reasonable. A country needs to grow. It needs infrastructure, investment, stability. And to do that, it needs capital. But many developing countries don't have enough internal resources to fund that growth on their own. So they turn outward. They borrow from international lenders, from financial institutions, from global markets. At first, this works. Money flows in, projects are funded, the economy begins to expand. And for a moment, it looks like progress. But borrowing comes with conditions, repayments, interest, and often policy requirements. Because lenders don't just want to be repaid, they want to reduce risk, which means they start influencing how that country manages its economy. Spending decisions, tax structures, trade policies. And slowly, control begins to shift. Not completely, but enough to shape the direction of the economy. And this is where the cycle starts to form. Because the initial growth created by borrowing isn't always strong enough to sustain itself. Projects take time to deliver returns. Global conditions change. Exports fluctuate. And when growth slows, repayment becomes harder. So what happens next? The country borrows again. Not to grow this time, but to manage existing debt. And that's where the shift happens. From borrowing for development to borrowing for survival. And once that line is crossed, it becomes very difficult to go back. Because now, a larger portion of the economy is focused on one thing: debt repayment. Money that could be used for growth gets redirected into servicing loans, into maintaining stability, into keeping the system running rather than improving it. At the same time, external pressure increases. Lenders push for reforms, spending cuts, policy changes, all designed to stabilize the system, but often slowing growth even further. And this is how the cycle reinforces itself. Less growth leads to more borrowing. More borrowing leads to more pressure. More pressure leads to slower growth. And over time, the country becomes locked into a structure where it can't move freely, because every decision has to pass through the constraints of the system. And this isn't just about debt, it extends into trade as well. Many countries become dependent on exporting a small number of goods, often raw materials or low-value products, which makes them vulnerable. Because if global prices fall, their entire economy slows down. And when that happens, the cycle begins again. More borrowing, more pressure, less control. And this is why escaping the system is so difficult. Because it's not just one problem, it's multiple layers, all reinforcing each other. Debt, trade dependence, external influence. A structure that keeps pulling countries back, even when they try to move forward. And once that structure is in place, it raises a much bigger question. If the system is designed this way, who actually benefits from it? So if some countries can't escape the system, what does that really mean? Because on the surface, it still looks like every country has control over its own future, its own policies, its own decisions, its own direction. But underneath that, there are limits. Limits created by debt, by trade dependence, by the structure of the global economy itself. And those limits shape what's actually possible. Because once a country becomes dependent on external financing, it doesn't just borrow money. It gives up flexibility. Decisions that might benefit long-term growth have to be balanced against short-term obligations. Spending has to be controlled. Policies have to align with expectations from outside the country. And over time, that reduces the ability to change direction, which is why the system feels difficult to escape. Not because countries aren't trying, but because every path forward is constrained. And this is where the story becomes bigger than any single country. Because this isn't just about failure, it's about structure. A global system where some countries sit at the center and others operate around it. Where money flows in certain directions. Where influence is uneven. Where opportunities are not distributed equally. And once that structure is in place, it tends to reinforce itself. Countries at the center have more access to capital, more control over financial systems, more influence over global rules, which makes it easier for them to maintain their position, while countries on the outside face tighter constraints, higher borrowing costs, greater exposure to external shocks, which makes it harder to move up. And over time, that gap becomes persistent. Not because it's impossible to change, but because changing it requires breaking out of multiple layers at once. Debt, trade dependence, system constraints. And that's what makes this so difficult. Because even when countries grow, even when they improve, they're still operating within the same structure. And that structure continues to shape the outcome. So the real takeaway isn't just that some countries struggle, it's that the system itself plays a role in why. And once you see that, you start to look at global economics differently. Not just as competition between countries, but as a network, where position matters as much as performance. and where moving up isn't just about growth, it's about escaping the structure itself. This is Empire Economics, where we break down the systems shaping your world, one story at a time. And once you see it, you can't unsee it. Thanks for watching.